Thanks everyone for joining us. My name's Nathan Faith. I'm here with my partner Joe Bloodgood. And today we're going to talk about how your charitable planning can minimize your tax bill each year. Joe, would you like to introduce us to how our tax system works with charitable contributions?
Hi, Nate. Absolutely. Yeah, it's great to be with you. So, just to kind of set the stage here, if we think about the standard deduction on a joint tax return for the year 2020, currently it's $24,800. Basically, what that means is right out of the chute, regardless of what you do, every married filing jointly tax return is going to have a standard deduction of about $24,800. Next, let's talk about how do you influence that standard deduction? In other words, at what point does it make sense to itemize your taxes because you can create a deduction larger than $24,800? So first, you can take up to $10,000 between state and local taxes. Next, you have charitable gifts. And as you can see here, unless you're giving charitable gifts beyond $15,000, you're not really getting much of a tax deduction for them. Now, for a lot of people, the main motivation of charitable gifts isn't necessarily a tax deduction, but when you can combine charitable gifting with thoughtful planning, as you'll see, we can make a huge impact with the way your dollars are used. So, Nate, with that as a backdrop, take us through a scenario where you compare what a traditional charitable gifting scenario might look like with where we might come in and apply some planning to it to create a bigger, more impactful tax deduction for a client.
Thanks, Joe. Many of us have a budget for most any major expense each year, and charitable giving is no exception. However, we're incentivized to gift on the tax front with the illustration that Joe just went through. But if we can change our perspective on how we give to charity, we can maximize our tax savings so that Uncle Sam is really contributing alongside us. So here's an example. Imagine a married couple who gives $15,000 a year to charity. And as we went through before, they really receive very little additional tax benefit for giving to charity because between their itemized deductions, whether it be charitable gifts, state and local taxes, mortgage interest, medical expenses, the standard deduction is about equivalent to their itemized deductions. Knowing how the tax system is structured can lead to some unique opportunities with our planning. There's a strategy that we can deploy in which instead of giving the same amount to charity each year and receiving little tax benefit, we instead pre-fund a charitable account with multiple years worth of charitable contributions. We can maximize our tax deduction and yet still gift the same amount of money to charity each year. The strategy is called the lumping or bunching strategy with charitable giving. And there are accounts out there called donor advised funds in which you can donate multiple years worth of charitable contributions, receive the tax deduction the year that you write the check, but you can distribute the dollars out to your preferred charities on your timeline, just like you normally would. But the end result is you receive a much larger tax deduction and save more in overall tax dollars by using a different lens to look at your charitable gifting. Maximizing your tax deduction is important, but it's just as important to know what it's worth. Joe, do you want to speak to the value of that tax deduction?
Thanks, Nathan. Let's take a look at the benefit of charitable contributions. Sometimes I think it's helpful to actually view that. And so on the far left-hand side here, you can see in the charitable deduction columns what the ordinary income tax bracket looks like at the federal and at the Minnesota level. So for example, if you're able to make charitable contributions over and above the standard deduction we talked about earlier, you're able to achieve that kind of tax savings depending on where your income lies. So for $250,000 of income, you'd find yourself in the 24% federal bracket and about 8% at the Minnesota level, about a 32% tax savings. That's pretty tough stuff. But if you're able to actually go above and beyond and gift highly appreciated securities, you can achieve an even higher level of tax savings. So we talked about the deduction. You know where your income lies. You know what income tax bracket you find yourself in at both the federal and at the Minnesota level. When we gift highly appreciated securities, we also save on other tax. So in addition to what we talked about before, we save on long-term capital gains and qualified dividends. Depending on where you lie, that could be 15 or 20%. You tack on the extra Minnesota income tax that's involved with that. That could be up to almost 10%. And some folks find themselves in a situation where they're paying almost another 4% net investment income tax. Now, if you total those, you can see tax savings anywhere from about 21 to over 80%, depending upon where your income lies.
Thanks, Joe. Hopefully you find it fascinating and surprising how far your charitable dollars can really go if you gift them in the right way and at the right time. With appropriate planning for those in the top tax brackets, they can experience a $4 match from Uncle Sam for every $1 they ultimately give to charity, which is really the power of planning. So if you'd like to align your charitable goals with your overall financial plan, feel free to reach out to us at learnmore@boulaygroup.com.